talk to REC. The case for a chat here being just getting a general sense of what the outlook ahead is post the first quarter getting over, the impact of the weak currency, and of course the outlook on the power sector stress as well is something we'd like to find out with. Let's welcome on board PV Ramesh, the CMD at REC. Mr. Ramesh, morning. Thanks so much for joining in. Q1 did see margins come under pressure for you, and profits as well were supported by another income component. Loan growth also remained flat. What led to pressure on operating performance for you?
First, let me set the record straight. I mean, for a company like REC, which is in the long-term power financing business, a quarter-to-quarter assessment is not really an appropriate instrument. Nevertheless, I mean, let's take for what it is. I mean, you can see that we are the first quarter, you could see very clearly that there is an overall positive trend compared to the last year in terms of the profitability, in terms of income, and in terms of the provisioning we have made in terms of all the credit impaired assets being brought on the book. We have adopted the new India accounting standards. So what we have really is a clean slate and an optimistic future to go forwards. Now, let me also speak about the margins. The yields continue to be high among the peers. It's more than 3%. And this is notwithstanding the fact that the cost of borrowing itself has gone up. We continue to be competitive and maintain our profitability. And much more important, I think we need to place this entire context is in which what you clearly see is that the power sector is rapidly gaining momentum. And the most important and significant factor that you notice is that the demand is growing. For the first time, the peak demand last week has touched 172 gigawatts. You could see in Maharashtra state alone, this year's demand has increased 22% compared to the last year.
Right. Mr. Ramesh, the new accounting standards clearly have impacted your net worth by about 6,000 crore rupees. Could you explain this? And also, how has it impacted your overall asset quality too?
Okay, first and foremost, I mean, let me keep the record straight. I mean, it is not 6,000 crores. It is at the gross level about 3,300 crores. The second important thing is that you can see from the results that we have published, we have brought all the projects which are credit impaired on the book. We have made aggressive provisioning. Aggregate level is about 47 odd percent, nearly 50%. Some of the assets we have made much higher provisioning, and this is based on the estimated credit impairment, which was a fair value that was determined by the Fitch credit rating agency. They have done this assessment based on which we have made this provisioning. So which we are very confident that we have now a clean book. We could only go upwards now. There are actually quite a few assets that should become standard in coming months, coming quarters. There are 2 hydro projects. There's Lanco Anpara, which is a major project again, which was caught up in a regulatory litigation that is likely to be resolved. So we would see, and there's an SR transmission company which is being commissioned next month. So we could only see improvements, and there is so the asset quality we are fairly confident, as you know, could only improve in the IPP segment. In the government sector, where we have 86% of our loan book exposure, we do not have any credit impairment at all, as you could see from the results that we have published.
Right. The Reserve Bank, Mr. Ramesh, declined any relaxation to power asset ARCs under the Parivartan scheme and has been firm on the power sector NPA stress as well. Assuming there is no respite even from the Supreme Court on the issue, what could be the stress for the power sector in terms of NPA and provisions both?
Let me put this in a perspective. Actually, we have conceptualized and proposed Parivartan as a optimal resolution proposition for the stressed assets, taking into consideration as the sector as a whole, not just the REC. So it's not really an REC product, but it is a sector-wide proposition, considering that we work across the value chain, across the country, and we have a stake in a robust power sector. So what we see really is that there are almost about three buckets, about 60,000 megawatts of stressed assets. If you see, 1/3 of them really are irretrievable. They are very early stages. They go to the NCLT. Then there are 1/3 which have partial PPAs or FSAs, but they do not yielding adequate revenues to service the debt. And then you have the third, which have actually suboptimal PPAs or FSAs or none of them. Now, what we have proposed is that as we are at a stage of a moderate demand paradigm, we are making a transition to a high demand paradigm, and very soon there is likely to be a high demand for power, and for the reasons I've said earlier, and the investments that are being made in the transmission and the distribution segment, which are unprecedented, 1 lakh crores each from the government alone. I mean, this is not counting what the DISCOMs are investing. So this is a massive modernization of the distribution infrastructure, which should really, and with the Saubhagya push, which reaches out to every household, the demand is likely to pick up very, very fast. And so the proposition is to really warehouse these assets, operate them, protect their value, preserve them, and then when there is an upside, and that upside will be shared by the financial institution.
Right. So how much of your total stressed assets do you currently have on your books, and what are the incremental provisions that you have to make? And what could be the stress for REC if there is no respite for power sector from the 12th Feb circular?
We've been very aggressive in the first quarter in terms of provisioning for those credit impaired assets. And we have brought them all on the surface. We have shared this with the analysts. Those who are further interested, we will share the specific case-by-case details. In all these cases, we are part of a consortium. We are working with the other partners to find a quick resolution mechanism for them. We are optimistic that at least some of them will be resolved soon, and some of them perhaps will take time. Some of them perhaps will go before Parivartan. And as I believe that as we speak, there would be no further need for additional provisioning in the quarters to come, other than what is mandated by the Reserve Bank of India. However, in fact, on the contrary, I would like to believe that some of these assets would soon become standard, and we are at an advanced stage of resolution for some of them.
Okay. How exactly do you think the weak currency is going to impact your financials, and how much exposure would you say on your books is still unhedged, and how much mark-to-market hit would you then take in the next 1 to 2 quarters?
Oh, okay. I mean, actually 85% of our foreign borrowings are hedged. So in that sense, it's on the plus side. I mean, as you can see from our books, that's a positive for first quarter, and that is likely to be positive for the second quarter as well. And the 15% which is unhedged is really in the long-term bonds that we raised recently. In the past 1 year, these are 10-year tenor bonds. We have done a tactful management of these. So we are actually likely to, in a way, benefit rather than be impacted by the rupee depreciation.
Okay. What is your view then, Mr. Ramesh, on margins in a rising interest rate scenario? Would we see margins under pressure, and how is it that you plan to protect your margins?
I mean, yes, of course. I mean, there is a rising cost of borrowing both in the domestic and the international market. However, we are trying to keep our borrowing cost low. As you can see from the first quarter, our borrowing cost was average was 7.25%, and of course much of it came from the 54 EC bonds, and that continues to be one source, the substantial source, though not a major source of raising resources. We will continue to raise resources through a mix of loans, bonds, both domestic, international market, to see that we keep our borrowing cost low to the extent that it is possible and feasible. And on the lending side, I mean, it would be inevitable to pass on to our clients to the extent that's possible. We are likely to revise our rates in tune with the markets in order to remain profitable. I mean, we do not believe that we can bring down our margins. Which is now yields are around 3% and margins are about 3.5, 3.6%. And there would be some pressure on them, but we would continue to see that we remain profitable.
Okay. ECBs form nearly about 13% of your overall borrowing, Mr. Ramesh. Would any of the recent measures announced by the government to stabilize Rupee then help REC?
I mean, of course, I leave the macroeconomic management to the Reserve Bank of India and the Government of India. And speaking for ourselves, I mean, for REC, we have an approval from RBI for raising $2 billion ECB during the current financial year, and that's in the next 6 months. We have plans to raise a substantial amount in the 144A, the American market. We have already launched preparatory activities in that direction. So that would be a major step in the coming month, in the next month. Now that the withholding tax has been is being removed from the masala market, we will take a close look at that very soon. So these are the two things that we will be doing very soon to support the efforts of the Government of India in terms of stabilizing Rupee, because we have about $2 billion approval and we have a MTN program for $3 billion.
Right. What is the growth outlook then going forward, Mr. Ramesh? Which segments, according to you, will be driving growth? And if you could just give us a little bit of flavor as to what your overall growth outlook is for the next 1 to 2 years.
No, I think the growth essentially would come from a number of areas. On the generation front, though there would be muted investment from the IPPs, there continues to be investment from the state and the central sectors in the thermal and hydro generation stations. Now here, because this is also on the account of the fact that almost 20,000 megawatts of power plants would have to be retired because they have outlived their utility, and more importantly, retrofitting of the FGD infrastructure in the to the existing thermal power plant. So this is one area. The second big area is the interstate and intrastate transmission infrastructure modernization, which is being done by our subsidiary, which is through a tariff-based competitive bidding. So there the private sector is actively participating. We are financing some of those projects. And the third most important is the renewables. I mean, the renewable energy projects are growing at a fast rate. As you could see, first quarter 18% of our disbursement was from renewables, and our as a total loan book, about our contribution to renewables has grown from 1% to 4% over 1 year.
Okay, Mr. Ramesh, good chatting with you and good to get in clarity as to where the business is headed in times like where you're seeing pressure for the power sector and of course currency depreciation as well.